Get to our jobs panel for some instant reaction. Joe Lavorgna, SMBC Nikko Securities of America chief economist and former chief economist for the National Economic Council. Betsey Stevenson, University of Michigan professor of public policy and economics and a former member of the President's Council of Economic Advisors. We still have Steve Leisman and Rick. I know our guests are working with us on Friday, but I just got to start with Leisman because he gave us all the pregame forecasts. Steve, it really is, you know, if it had been, I think if players were set up for plus 400,000, that did not happen. So it wasn't one of those shockers either way. It was, what, 6,000 above the estimate.
Well, Joe, there's a little piece of this that makes me think it's a touch weaker than expected. And that's because if you just do the private sector, it was 189. And remember, that's what ADP is forecasting. They were down at 145. There were 47,000 jobs added from government, most of that being, or about half of that was local education and local government. So in terms of the private sector, it's a relatively weak number. The other aspect of this, which is that you had the leisure and hospitality up by 72,000, that's a sector that's still striving to get back to where it was before the pandemic. But we saw retail down 14,000. We saw construction down by 9,000. I guess I think that there's some sort of differentiation finally going on in the job market right now, as opposed to just hire. If you saw the story today about the person who was hired at Meta and didn't have anything to do for a long time until they finally left. I think that may have stopped, Joe. The silliness may have stopped, and maybe there's some actual thinking about who to hire, where to hire them, differentiation by sector. So I'm going to say this is not as strong as it.
The big companies, right? The big
yeah,
tech companies.
Exactly.
Yeah.
I'm just going to say on the surface, not as strong as it appears on the surface of it. And then the idea of people coming back into the workforce, that's disinflationary. So I think this is a better report for the Fed than it appears on the headline numbers.
Okay. Betsy, do you have similar feelings about this or opinions about this as what we just heard?
You know, the last point was one I was definitely going to make. Look, what the Fed needs to see is people coming into the labor force, and we saw that. We saw labor force participation tick up. But actually buried in that is incredibly good news, which is that it came from men. And that's where we've struggled, is to see the men coming back into the labor force. Realize that we've gotten older as a country since the pandemic started. And so getting back to our old labor force participation rate is quite extraordinary. And it means that the labor force participation rate of our prime age people, 25 to 54, is well above where it was prior to the pandemic. And that has been driven by women. So it was thrilling to see male labor force participation tick up here. You know, in terms of the government jobs, you know, the thing is that we have not seen a recovery in government jobs. As of last month, for every 100 every 100 men who worked in the public sector before the pandemic, we only had 97 men. For every 100 women, we only had 99 women. So we you know, seeing some recovery in government is expected. And I think what is really the story here is the ongoing reallocation in our economy. The goods sector lost jobs. Those private sector jobs that we got, it was -7 goods sector. All of the addition was in the service sector. Where were the majority of the jobs in the service sector? Exactly where we would expect them, in the sectors that have been slowest to recover: leisure and hospitality, and education and health services.
Okay, so Joe, the disconnect between what the Fed says and where the bond market has been, does this number confirm that the bonds were on to something, or are both the Fed and bonds can still be right about what the future actually? No one knows still, so this doesn't settle.
Right, anything. No one knows still.
Doesn't settle.
Yeah, anything. I mean the economy is bending. Labor market is certainly slowing. You're seeing that in the various PMIs. The claims numbers with the revisions are important. This is a bit disinflationary in the sense that labor supply is increasing as labor demand is slowing. We saw JOLTS really weaken. When I saw the data, I thought, oh my gosh, the next thing we now have to focus on is the CPI. It was sort of a very more or less as consensus report. The private number that Steve mentioned, being under 200,000, is noteworthy. We continue to slow. The market now is going to debate, Joe, whether it's 25 or nothing. at the May meeting, and that could come down to the next set of data. So again, we're at this fulcrum. Are they done tightening, or are they going to maybe go one more time? That hasn't been resolved, so the markets and the Fed are still sort of in the same zip code.
Well, that's a lot of people would settle for that binary choice, one more time or none. There's people that think they're going, 5, 6 more times.
No, they can't go that much, Joe. Not with what the curve is telling us, and not certainly what's happening on the banking side. The Senior Loan Officer Survey on May 8th is going to be very important. That should show further significant tightening. And that lending data is very forward-looking. I mean, it tells us where the economy is going, and that has to tighten given what we've seen with the regional banks.